Important thing today, we're about even on the advanced decline line. Despite the weakness in tech, we've got strength in energy, some of the banks doing better, materials. But I think tech is the key story right now. Take a look at not just Apple, but really the semiconductor group overall is fairly weak here. Apple's down 4%, as you can see. That's the lowest since early August for sure. Micron, Advanced Micro, NVIDIA, all on the weak side. This is the second day of weakness for semiconductor stocks. Elsewhere, just let me show you some other things. The utilities are notably weak. We've got a couple of big utility names that are, of course, involved in that fire over there in California, PG&E and Edison International. Those are not typos. That's down 30% there for PG&E and Edison. That's dragging down the entire utility group. Oil is finally rallying. What a disaster the last few weeks it's been in oil. There's been talk Saudi Arabia might finally start to cut output. I just want to know, people have asked me all through in the last week, why is oil stocks holding up so well? You see most of them are up and finally bouncing today, although Hess and EOG are not. But the key reason oil stocks have held up while oil has been going down is a lot of them have significant gas exposure, liquid gas as well as natural gas exposure. So if you take a look here in the last month, oil has gone essentially straight down. That's your orange line there, while natural gas, which is the green line, has rallied significantly. In the middle of that white line, those are oil stocks. And the reason you're having oil stocks hold up is because the significant natural gas component a lot of them have. If you take a look for the last month, stocks that have significant oil and gas exposure, like Anadarko or Pioneer or Cabot Oil and Gas, EQT, even Exxon, which has some fairly significant oil, natural gas, has held up as oil has gone straight down. So if you look at some of these companies, the percentage of sales they get from natural gas, it can be very, very high. I'm choosing the ones that have the highest exposure to natural gas, but Cabot's got 80% of its revenues, EQT, Range Resources, Southwestern, Anadarko, you get the point. These are not insignificant numbers, and when nat gas goes up, they're not just oil stocks. They're also natural gas stocks. Everybody just bear that in mind. There's two things I think could help a year-end rally. First is any news that were some truce on the whole China trade front, maybe not imposing the tariffs on January 1st, additional tariffs. But the other thing is the reasonable valuation, a valuation rally. We're much better shape than we were earlier in the year, and we're much better shape than we've been in the last 5 years. These are Oppenheimer numbers over the weekend. The S&P is at a 16-time 2019 multiple. The 5-year average is 16.5. It's cheaper. Energy is notably cheaper. We're down 14 times. Look what this has done, this decline that we've seen in the last few months. 5-year average is 29 times forward earnings. Industrials also are significantly cheaper than their average. 15.4, 2019, 16.4 is the average. The only thing that hasn't changed that much, technology. Still a little bit expensive compared to its 5-year average. And of course, as we see some of the big tech names like Apple come down, I think that'll also go closer to the 5-year average. Right now, the Dow is sitting right near the lows for the day. Carl, back to you.